section, which is going to be on entries. So far now we've learned how to build a solid story, narrative and understanding behind price, understand intentions for where we can expect to see price head next. We've then learned how to understand that across multi-time frame, understand multi-time frame swing structures. From that, we've managed to be able to understand supply and demand levels across multi-time frame. And then we've learned how to build the confluences to see which supply or demand levels hold most weight. But now we haven't even learned yet how to actually get involved in these trades. How do we capitalize? How do we make percentage? How do we make our money? Okay. And now what we're going to do is teach you now the next step of adding all of this onto it, which is entries. Because like we've said before, we've built that story, we've built the supply and demand levels, we've built everything we need to know. We just need to now add that final little bit, which is entries. Now we've said before, and you'll hear us say, what we do is we wait for price to come and tap into these levels, so these supply and demand levels, then we wait for entry criteria and look to get involved in the trades, okay? So there's two different ways you can enter a trade, okay? And these are risk entries and confirmation entries. We're gonna go through the advantages and disadvantages of both, okay? We're gonna then choose and understand which ones might be more suited for you. So there's not a right or wrong way to trade. Some people prefer to take risk entries, some people prefer to take confirmation entries. There are advantages and disadvantages of both, whether you can be on the computer, whether you can't be on the computer, whether you work a full-time job, whether you can sit and trade the sessions, there's so many different variables that can choose which ones you want to trade, and you'll be able to choose and understand which ones suit you. So for me personally, I take every single trade as a confirmation entry. The simple reason for that is you get extra confirmation, okay? And this is something we're going to go into. Whereas a risk entry, you get less confirmation, but there are advantages and disadvantages of both. So like we said, we've taught structure, understanding it from a multi-time frame perspective. We understand how to build story from higher time frame to lower time frame swings. We've learned how to identify these supply and demand levels. And what we wanted to really do is teach you how to trade this from a fractal understanding, to be able to understand how you can trade this in any way you see fit. Because the most important thing in trading for me is being able to adapt it in a way that suits you. Because trading is very subjective to the individual. It's very much something that has to resonate with you. It's all good and well understanding how I trade or how anybody else trades, but how I trade might not be how you want to trade, okay? So I might be someone here who takes 1 pip stop loss confirmation entries on the seconds, but that is not for everybody. Not everyone wants to be that aggressive. Some people want to be able to trade more of a swing style approach using high time frame confirmation entries, trading with like 10 pip stop losses because they are more swing style position traders. And there's no right or wrong answer to this. We want to teach you the understanding and the concepts behind different ways to enter the market. And then we're going to teach you then in the later videos how to adapt this in a way that suits you. How you can trade any time frame that you like, any time frame swings, be any sort of trader that you like, and enter any positions or any trades any way you see fit and what suits you. So what we're going to do is we're going to talk about the two different kinds of entry criteria that we have, being risk entries and confirmation entries. So on the left hand side, we can see what we've got is the risk entry, and then on the right hand side we've got what's called the confirmation entry. So just in the names, you can sort of tell by the names, you've got the risk entry, which is, if you want to call it, the more riskier entry, and then you've also got the confirmation entry, which is where you're getting that extra bit of confirmation, so it's sort of the less riskier entry. Okay, you've got the risk entry, which holds a little bit more risk, and the confirmation entry gives you that little bit of extra confirmation. Now each ones have their advantages and disadvantages, and we're going to talk about them in a minute. So you might be thinking, well, if confirmation entry has more confirmation and it's not as riskier, why don't people take it? Why don't people do that? And like we said, we're going to go through it now. So the first thing that we have is the risk entry, which we can see on the left, okay? We can see we have bearish market structure, we have the lower high, lower low, expectation for a lower high before a new lower low in the market, okay? Now we understand from what we've talked about before, what do we expect? We would expect price to come and tap into a zone that we identify, in this case a supply level, wait for price to come and tap into the zone, and then we look to get involved in our trades. You've heard me say this many times before. So how do we get involved in the trades on a risk entry? It's very, very simple. So we have what's called a risk to reward tool, which we can see is what we've got here. So we can see we have a long position and a short position. You can get them in the toolbar on the left hand side. You can see we have a long position and a short position. So a short position is when we're looking to sell, and a long position is where we're looking to buy, okay? You can see these here. If you want to add these to your toolbars, you can press the little stars by the next to them and it'll add it to your toolbar. So any tools that you want to do, you can do that, okay? So we understand that when we have bearish market structure, we have supply levels created, which are these last buy candles before the sell. We understand that what we're looking to do is we're looking to sell the market because we have an expectation to target the weak low and take the new lower low and take the liquidity below the weak low, and our protected high always remains intact until violated. So In this case, what would we be looking to do? We'd be looking to sell the market. So we'd be looking to take a short position, okay? So what we can see here is if I get my short position tool right here, we understand that we have multiple supply and demand levels on the charts, okay? And we can see here that we have identified, just to keep it simple for now, a supply level. So all a risk entry is let's just say you've got your swing structure and you've mapped out your supply levels, in this case, that you're looking to trade from. You're simply placing what is called a pending order or a limit order on your supply level. And what this means is that you're setting your order in your trade before price has tapped into the zone. So like we said, you've heard us say before, we wait for price to come and tap into the zone, look for our entry criteria and look to get involved in the trades. This is what we call, that's more the confirmation entry stuff, okay? Which is what that is all about. But what the risk entry is essentially you're placing your order on the supply level. So this bottom line right here, so you can see where it crosses between, in my case, my colors, we've got like the blue and the red. The middle black line is your entry box. So the second price, for example, if we were to set our entry criteria, our risk to reward tool on the edge of the supply level here. So what we expect price to do is as we know, we expect price to come and tap into the zone before price continues, okay? So the second now, if we were to set, this is where the entry execution would start, which would be on the open of the supply level, and then this top part here is the stop loss, okay? So what we do is we just put the stop loss just above the supply level and our entry just at the open of the supply level. So what you can see here now is what a risk entry is that we wait for price to come and tap into the zone, and like you've heard me say, we wait for price to tap in, give us our entry criteria, and then we look to get involved. But what a risk entry is you're basically, the second price taps into your supply level, you are automatically in the trade. So you set your order on the supply level, and then the second price is tapped into your zone, your supply level, you're automatically in the trade, okay? So we can see here as price is coming up, okay, the second now price is tapped into this supply level, okay, we are automatically in that trade, okay? Doesn't matter what happens now, we are in that trade. If price comes and breaks above the stop loss, we're out of the trade and we've lost that trade and we'll lose however much we risked on that trade. And then obviously if then price continues and goes down in this blue area, okay, that's our profit area, and we obviously understand that we expect to see a new lower low in the market, so we can obviously target down here, but that's going to be in management later on. So what the risk entry is setting a pending order or a limit order on a zone, on a supply or demand level before price has tapped into the zone, okay? And then when price taps into our zone, we are automatically tagged into the trades. So why might this be good? Why might this be handy? Okay, so if you're somebody who maybe is a swing style trader or somebody who doesn't want to be glued onto the computer, okay, what you can do is wait. Once you've had your confirmation essentially from another zone, for example, what you can do is you can place your risk entry on your zone, set your pending order and walk away. You don't have to sit in front of your computer. You can set your entry. You can then, if price comes and taps into your zone and then it tags you into the trade, you don't have to worry about it, okay? So you can set it, leave it, and not have to worry about it. So you can set the order, walk away from your computer, go for a walk, do whatever you need to do and go about your day, okay? Whereas the confirmation entry is something that we're going to go into, requires you to have a little bit more time. You need to sit on the computer a little bit more, depending how actively you trade. Obviously depends on the time frames as well. But the risk entry is essentially when you've got your supply or demand level, you're simply placing a pending order, which is an order before price is tapped into the zone. And what happens is the second price is tapped into that zone, that's when that tags you into the trade, okay? That is what a risk entry is. So now what is the confirmation entry? If we think about it from that perspective, what are we doing? So if you look at the image on the right-hand side, what can you see? We can see our created supply level, okay? Just like we have here. Now, the risk entry would simply be, we can get the short tool, we'd put it on the open of the bottom of the supply level, we'd cover the top, okay, we'd cover the top of the supply level, okay, and that would be our trade, okay, that would be the risk entry, okay, because what we're doing is the second price is tapped into that zone, okay, we get tagged into the trade. But with a confirmation entry, which is the main way that I trade and most people trade, that's not what you're doing, okay? You're waiting, it's in the name, you're waiting for confirmation, okay? So what we can see here is we can see price comes and it comes up. We can see the bearish market structure, lower high, lower low. We can see what we've already got is a lower high before any lower low. So now what the confirmation entry is you're waiting then for price to tap into the zone. So price can tap into your supply level, but when it taps into your zone, you haven't got a trade set yet. So whereas with the risk entry, the second price taps into your zone, you're automatically in the trade, okay? Whereas with the confirmation entry, you are not in the trade when price taps into your zone because you haven't set a trade yet, okay? But what you're looking for is you're looking for confirmation to that zone. Okay, so let's say we are on a 15-minute time frame here. Okay, we have 15-minute structure, and this is the lower high, the lower low, and then we expect the new lower high before a new lower low. Okay, let's say now this is our 15-minute supply level. We're going to understand how to really choose our time frames later on when we come to fractal confirmations. But what we can see here right now is what we've got now is price has tapped into the zone, but what can we see? Okay, you can see we've had the change of character. Okay, so price has tapped into our supply level in this case, and what can we see? We've had that switch from bullish to bearish intentions. Okay, so we can see price has been bullish. Okay, bullish, bullish, bullish. Price tapped into the zone, and then price has shifted from bullish to bearish. Okay, and you can see that. Okay, so now what we've got here is we've got that order flow realignment. We've waited to see order flow and structure realign with our swing structure. So the difference is when we look at risk entries in this case, if we were to set a risk entry here, we've not had any indication that price wants to realign with our swing structure. So when we think about when we go back to internal structure and swing structure, we understand right here, this is our swing structure being bearish. And what can we see here? We've got bullish internal structure and bullish order flow. Okay, so we've not had any confirmation when we've tapped into our zone that price wants to go bearish yet, which is our given direction we expect price to go in. Okay, because we understand we have lower high, lower low, lower high, lower low. Okay, we've not had any confirmation yet that price wants to go bearish. Okay, so the risk entry is taking a trade and basically entering off the open of a supply or demand level before you've had any confirmation it actually wants to go bearish. Okay, so when you've set this order here, you can see bearish swing structure, but what have we got? We've got bullish internal structure and bullish order flow. We've tapped into the zone. If this bullish market structure was to hold, okay, we can see higher high, higher low, higher high, higher low, and price could continue on and go in our given direction being bullish, say. If, obviously we understand this is protected, but that is still possible. We've had no confirmation. This zone wants to give us bearish intentions yet, whereas the confirmation entry gives us just that. So we can see here now, we've got lower high, lower low, lower high, lower low. Okay, we can see bullish internal structure, bullish order flow, bullish, 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 bullish. We've tapped into our supply level, and then what have we got? We've got the highs gone, lows gone. We've shifted from bullish order flow to bearish order flow. We've got confluences here, which they're the same confluences that we have in supply and demand. We're going to go into this in the next video, but we can see here now what have we got? We've now gone from bullish market structure to bearish market structure. We've had a supply and demand flip, and now what's happened is you can see the shift from bullish. Okay, it's gone from bullish now to bearish. It's created a newly created supply level, and our entry is now off this supply level because what's happened? We've had some sort of realignment and confirmation that price wants to go bearish now. So we've got bearish swing structure. We've tapped into our supply level that we can expect to see price go from. We've tapped into the zone, and now we've had lower time frame confirmation that price wants to go from this supply level. Okay, so what we mean by lower time frame doesn't have to mean seconds or the 1 minute. Okay, in this example we understand that we said 15-minute. Okay, so if we had 15-minute swing structure already being bearish and a 15-minute supply level, we can then see, say we can drop down to the 1 minute, and if we see the 1 minute realign with the 15-minute and give us this confirmation, we can see the change of character, we can see our entry model happen and give us a newly created supply level. Okay, then we can look to take that trade because now we've had that sort of internal structural realignment occur with the swing structure. So we've had confirmation. So then our entry would be, we can see here now, if we were to delete this, we can see here now that we've had the shift from bullish to bearish. We can then see here we've had what's called a supply and demand flip, or this would be a demand to supply flip. Then we can see here now we've formed a newly created supply level. So again, the entry would be on the open of the supply level, and the stop loss would be just above. Okay, would just be above the supply level, and then obviously again we'd look to target the low because we understand we have an expectation that this low should get ran. Now, if we think about the difference between the two, what are the advantages and disadvantages of both? So we understand here now, if we were to look at risk entries, we understand if we were to set a risk entry, the second we tap into our supply level, we're in the trade. We're automatically in. So we don't have to worry about potentially not getting tagged into the trade because the second this zone gets hit, we are automatically in the trade, okay? Whereas when we look at confirmation entries, let's just say we've tapped into our zone right here. The second we've tapped into it, unlike this, we are not in the trade yet, because what we're doing is we're waiting to see confirmation on a lower time frame. That could be 15-minute zones using 1 minute. It can be 4 hours supply demand levels using the 15-minute confirmation. We're going to go into this later on to how to choose the right zones and the right timeframes to use. But we can see here now that even though we've tagged into the zone and we've had a shift from bullish to bearish order flow in line with the swing structure, we've created a newly created supply level. But what can we see that I've done right here? We haven't been tagged into the trade. Okay, price has gone without us. Okay, so there's many different advantages and disadvantages to both. So with a risk entry, the second you're tagged into your zone, you are definitely in the trade, so you will not miss the trade. Whereas with a confirmation entry, you might not always get your confirmation. Price will never always give you your confirmation on the exact supply level you want. So you can see price will tap into your zone, give you a lovely confirmation to the zone. It gives you a beautiful entry criteria. You can see there clean as day, your entry criteria is set up, but price just goes without you, okay? And you don't get tagged into the trade, so you can miss the trade, okay? So that is the difference between the two. It depends how you want to be. So risk entries, you can guarantee yourself to be in that trade. Compared to a confirmation entry, you might not get your re-entry on that confirmation, okay? So these are the advantages and disadvantages to both. Now, the way that we teach, and we're going to teach you how to understand things with a good understanding, confirmation entries are the best way to go, because there is pretty much always confirmation to any sort of zone, okay? And majority of the time, there is always a way to get involved, okay? And we're going to teach you how, okay? So my suggestion would always be confirmation entries, because we're going to teach you a true understanding of how to get involved in the market. Whereas risk entries can be better if you've got this full-time job. You cannot be at the charts, or you just want to be someone who doesn't have to worry. You basically just set your trade, you set your entry, and you can walk away. It's complete down to the individual and what works for you, okay? So they are the advantages and disadvantages of both. Risk entries can get you guaranteed in the trade. Confirmation entries you might risk. But what we've got to talk about now is obviously the difference as well between the two. So like we said here, this one here, you've got no confirmation that price wants to go bearish, okay? So this can avoid you unnecessary losses, okay? So let's just say now we have smaller supply levels within, okay? Let's say we draw this zone right here, okay? We draw this zone, and we also draw this zone right here, okay? So we've drawn on two more potential supply levels, okay? Now let's talk about the difference between if we were to use a risk entry versus a confirmation entry. So if we look at this zone right here, the risk entry would be off the bottom of the supply level in this case, and the let's just draw it a little more accurately, and then the stop loss would be just above the supply level right here. So when you look at this, what has happened? We've taken a loss, okay? We've straight away taken a loss, because what has happened? Price has tapped into the zone, okay? And it's just smashed straight through. So we've just taken a loss. We've taken an unnecessary loss, okay? Because we were going against sort of within internal structure. We were bullish compared to the swing structure being bearish. We had no confirmation. So price could have gone off this zone, but we had no indication or intention or any sort of shown anything in the market to tell us that it wants to go off that zone. So if we you can set multiple risk entries. So you could set a risk entry here and a risk entry here, okay? But what we can see here is if we were to take this trade, we would have just taken an unnecessary loss, because what's happened, price has just come in. At the second it tapped into the zone, we'd have been tagged into the trade, and we would have got taken straight out, because we can see our stop loss was hit, okay? So that is the problem with risk entries, okay? You haven't got confirmation. So the good thing about confirmation entries compared to risk entries, confirmation entries gives you that extra bit of confirmation, so it can help you and give you a better strike rate overall, because you're not having to take unnecessary losses, and you're not having to sort of predict which ones it's going to go from, because if you've got 3 or 4 supply levels or demand levels, you don't know which one exactly it's going to play from. So if you were to set 3 or 4 risk entries and it goes off the fourth one, you could take 3 losses that were unnecessary, because if you were to wait for a confirmation entry, you can wait for price to tap into the zone, and a lot of the time you'll see you don't get any confirmation, because if we're looking at this from a bearish example right here, we understand that we have lower low, lower high, and lower low. We wait for price to tap into the zone, okay, or let's just say in this case, sorry, but what can you see here? We've got bullish market structure, which is that internal structure. Price taps into the zone, but because we're looking for confirmation entry, we understand that we wouldn't be in this trade yet, because we haven't had any confirmation. Price taps into the zone, okay, and then it fails, okay? So we can see here now that we would have missed out and not taken an unnecessary loss, because when we're waiting for confirmation, we have that confirmation and that shift in order flow, and we see that intent in the market that in this case bearish intentions want to come into play here. So the difference is, if we were to use a risk entry here, we would have taken an unnecessary loss, because you can see prices just come in and taken us straight out. Whereas when we tapped into this zone right here, we can see we didn't get any sort of entry criteria or any sort of shift on a lower time frame to show us that this zone wants to hold. So only until this zone holds and shows us sort of intentions that it wants to go bearish, giving us this sort of shift that we see here, that's when we can look to get involved in the trade. Now, I'm not saying that price can tap into a zone, give you confirmation, and sometimes you can still get stopped out, and there might be other reasons for it, but that confirmation is waiting for that extra bit of confirmation. So unlike this example here, we would have taken an unnecessary loss. With this zone right here, we wouldn't have taken a loss, okay? Because we understand that we're waiting for that confirmation. Price tapped into the zone, we wouldn't be involved in the trade because we haven't had confirmation. Price reacts to the zone, and then it just continues to go up, okay? So we wouldn't have taken a loss there. So that is the difference between the two. So it's down to you how you sort of adapt these and interpret these in your way. Personally, for me, how I trade, I will always wait for confirmation, okay? The only time I will ever use a risk entry, and think about the logic behind this right now, think of this from an understanding of protected and weak areas on the charts, okay? We can see, what do we have? We have a lower high, a lower low, a lower high before a new lower low, okay? Now, when we think of a protected high, what is the expectation of a protected high? We understand that we do not expect a protected high to get broken until intentions change. So when we've got bearish market structure, like we do in this case right here, we can, for me, what is valid to take a risk entry from, okay, is taking a risk entry off what we call the extreme. Now, what an extreme is a supply or demand level that is at the edge of swing structure. So if we were to look here, we can see that we've got one right here, and we can see we've got another supply level right here. So at this moment in time, we've got two supply levels, okay? This top level would be at the extreme because it's at the edge of swing structure, okay? It's at the protected high, okay? So think about this logically. If price is to hold and continue bearish in our given direction, if this zone has failed and we've only got one supply level left, okay, why is it valid to take a risk entry off this zone right here, off the extreme? Well, because we understand that if price is going to go in our given direction being bearish, okay, because we understand the expectation of bearish market structure, lower high, lower low, lower high, lower low, it is valid to take a risk entry off the extreme, okay, because we understand this is protected. We understand that we do not expect this high to get ran. So we can set, if we have an extreme of a swing point, we can set a risk entry on the extreme supply or demand level because we understand we don't expect this high to get broken. So as long as we cover this high, as long as the expectation of bearish market structure is to hold, which we understand is the case, because when we've got bearish market structure, we have protected highs, we do not expect this high to get broken, okay? So we can set a risk entry on extremes, okay, because we understand if price is going to continue bearish in our given direction, it has to go from here now, okay, because there's no other area that it has to go from, because if this high then breaks, okay, we've now got bullish intentions, because the thing is, if we were to set a risk entry on this level right here, okay, we could set a risk entry, but we still know we have this supply level at the top, okay, so price still has every valid reason to come up here, okay, before price continues, okay? But we understand now, if this is our protected high and our weak low, it is valid to take a risk entry off the extreme because we understand that the extreme is the last point price can go from to fulfill a structural expectation, okay? So this being lower high, lower low, lower high, lower low, we don't expect this high to get ran, and this supply level is at the edge and at the extreme. So we can set a risk entry at the extreme to continue to look to come and take it down. That is personally, in my opinion, the only time I'll ever look to use a risk entry. That is just something I wanted to put in there because I mostly always take confirmation entries. I always want to see confirmation of a zone. But if we do hit an extreme of a swing point, I will look, if it makes sense to, look to take risk entries. But what we're going through here now, we're going to take it onto the charts, but it's so important to test this. It's so important to try this out. So understand everything we've done so far now. Map out your structure, map out your supply and demand levels. All you're waiting to do now is just set random risk entries and then wait for price to tap in, see if you get this lower time frame shift, okay? And look for confirmation, okay? So all I'm going to do now is going to go take it to the chart, and later on we'll learn how to know which time frames to use for different zones, etc. But just start to have a look. Once you've mapped out your structure and your supply and demand levels, wait for price to tap into these zones, see if you get the confirmation, see if you don't, see if you would have taken losses, and just experiment and just see how it goes. So that's that video there right now. What we're going to do now is take it over to the charts.